Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're covering our program today is on investing basics for women. As I said, there's a lot here for everyone, but I want to, the focus on women is because of some of, as we said, women being uniquely suited for investing, and I was covering some of the reasons for that. When it comes to investing in general, like I said, we start with the basics of financial planning as well. This is very important when it comes to investing. So for instance, we start with what do you have for income? What are your expenses? What you have for assets? What do you have for liabilities? Now we want to make sure that we have, if there are liabilities, debt in other words, how we're going to pay that off, and that's going to be a big part of the plan. When it comes to your assets, making sure that's the investing piece, right? How we're going to grow those assets to stay ahead of inflation and taxes. Income and expenses, understanding what those are, okay? What your income is now, what it's going to be in retirement. Are you going to have a pension? Social Security, of course. How much is that going to be? And then relative to your lifestyle expenses, how much does it cost to maintain your current standard of living? Where do you spend your money? So it's, all the basics, utilities, your home expenses, food and dining out and entertainment, and of course, as I mentioned, taxes, insurance costs, medical costs, all of these things, vacations, fun money things, entertainment, hobbies, all of that goes into the equation, car expenses. We take it all in, and this is, understanding that, measuring it, and that's where it can differ for people, considerably. From people I've got that come in sometimes and they live very frugally, maybe $25,000 or $30,000 a year. Other people that, more in the middle range, it could range anywhere from $50,000 to $80,000 a year. And then others that maybe are higher earners, and their lifestyle might be in the six-figure, and low to mid six-figure range typically. So where do you fit in all that? And then how do we apply these planning then? These same principles will, no matter which way you fall, the same principles apply. Okay, so by the way, if you'd like to get a personalized plan, I'm going to jump back in here, but if you'd like to get a personalized plan that deals with all this, just be one of the first 10 callers to my office this morning at 615-376-5325. Tess is standing by. She'll get your information. She'll send you out a checklist of things to bring to your appointment with me. And what I'll do for you is I'll get a comprehensive plan, meaning that we're going to cover everything. All the things I just mentioned, income, expenses, assets, liabilities. We'll talk about Social Security, how that plays in. We do tax planning, taxes on Social Security, as well as taxes on other income, as well as taxes on your investment. Tax-efficient investing is another important part, as well as having a tax-efficient income plan in retirement. We get into all of that. I'll show you your financial future based on the things you're doing, and show you ways and share strategies with you on how you can improve that financial future to give you the security, the peace of mind, to be able to attain and maintain your standard of living and quality of life no matter how long you live, so you'll never have to worry about running out of money or having to cut back, and live on less than what you would prefer. In other words, how to, again, attain and maintain your current standard of living and quality of life. So all of that is a part of it. 615-376-5325. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. Okay, one of the things I do, the reason I do these kinds of things, a great way to get to know each other even more. Come in, we'll do the planning, and I'll show you the kinds of things I can do for you in the type of planning I do with my clients in the investment portfolios, so you can compare, and who knows, maybe you'll become a client as well. All right. No obligation, though, again, take advantage of it. And we're talking about, this isn't going to be just a simple consultation. It's typically going to be like 2 or 3 visits to do this, because we gather a lot of information, and we're going to do reports for you and share with you not only on investing, but all the other things that I mentioned, including tax planning, estate planning, all of that is covered. All right, let's go back to now in understanding the basics, all right? So when we learn the basics, investing basics starts with what I was just talking about a little bit, right? Identify your financial goals. All right, now the biggest one I deal with, of course, is planning for retirement, but learning about other options. Maybe you want to, a number of clients that I've got that either relocate for different reasons, or maybe purchase a second home. It could be a lake home, it could be a camp, it could be a, getting an RV that they like to travel. Could be getting a beach home, any of those number of things. What are your goals with regard to your savings? And maybe it's about helping. Maybe you're setting up 529 plans for your grandkids, or helping them with college expenses in some way. But of course, the big one again, investing now to help fund a comfortable retirement, to make sure you're going to be able to have a stable income from your investments in retirement to supplement your other income sources, to make sure that you're again going to be able to attain and maintain your standard living and quality of life. And in charitable giving, and we share different tips there. There's tax efficient options when it comes to supporting the causes or the charities that matter to you. So if you give to your church, for instance, we want to look at that, in particular with standard deductions being so much higher now, how to take advantage of some of the rules that are in place to help you, also minimize taxes on your charitable giving. And it just depends on, if you're talking about leaving a bunch of money, maybe even to a charity, we can show you a way to get some tax advantages through that will benefit both you and more money as well that you can give to the charity if you so desire. Things I've talked about, like qualified charitable donations, when you're above 70 and a half and you're taking required minimum distributions from your retirement account, here's another way that you're able to give directly to your charity through those RMDs, and in doing so reduce your taxes at the same time. All right, and it's not just if you take money out of a retirement account, you got to understand that if you don't follow these rules exactly the way they're written, it's the difference between maybe paying thousands of dollars in taxes and not having to pay any tax. All right, so it's important to understand these rules that the IRS gives us and how to use them to your advantage, okay? Now, another is identifying this. When it comes to the basics of financial plans, you got to, I show this a lot of times, we call it the roadmap, but basically this is where you have a certain amount. Let's say your expenses are, we'll just pull a number, $6,000 a month as an example. Then you want to have about $6,000 in your checking account as a rolling balance. You'll want to have approximately $30,000 to $40,000 in an emergency fund, okay, that you need to keep liquid for. We don't know what's going to happen, but something always does, right? So we want to have that money set aside for that purpose. Then you may have some short-term goals, a home renovation, or maybe you're going to buy a new vehicle, or whatever it might be. You want to have money set aside, not in the market, subject to volatility. That needs to stay more liquid. Now, each of these things can be in a checking account, a savings account, a money market account, maybe short-term CDs or fixed annuities if it's a short-term goal that you're going to need the money in, say, 2 to 3 years. We want to get some growth on it, but we also need it to be liquid when we need it. All right, that's the important part. So understanding this basics, getting that foundation down. Then we get into your long-term, talking about IRAs, SEP IRAs, 401ks, TSP, your thrift savings plan for you federal employees and military out there. All of this is a big part of understanding then how these things work. Your long-term fund is the one you're going to be looking to get the most earnings on, again, to stay ahead of taxes and inflation so that you're protecting the purchasing power. Otherwise, what you're going to see, if you just have all your money parked in a checking account or CDs, you're going to see that there's an erosion in terms of what those monies will buy over time. And that's where investing becomes so important, but then how to protect against volatility is the other piece. Estate planning is another part when it comes to the basics. Understanding, have a comprehensive financial plan, which includes the foundational accounts that I just mentioned, estate planning. It gets into how to, again, tax planning, long-term care, understanding healthcare costs. Now, long-term care, that's we get into that as well. I find many of my clients can self-insure, but there are different hybrid type of products out there that can allow you to get coverage without having to pay premiums. So there's a lot of different ways to take care of that one. And healthcare costs in general, understanding how much those are, understanding Medicare rules and how those apply and what out-of-pocket expenses you're going to have, and to plan for those accordingly. All right, investing basics, major asset classes. So let's cover this part. Now that we've, your basics of financial plan, that's what we just went over, right? Having a foundation, a good, strong foundation to build upon, having your house in order to protect against certain risks, and that goes with insurance, right? So if you have certain concerns about liability, maybe you need an umbrella liability policy. Of course, auto, home, all the different things that we're protecting against, health insurance, again, potential for long-term care needs, that's covered. And in your overall plan now, we've covered the risk area. Now let's move on to investing basics and understanding the major asset classes such as stocks. So stocks, now we're talking about what are we doing with a stock? We're buying a piece of a company, right? We're going to have ownership in that company based on that stock. Or of course in a stock mutual fund, we have a lot of stocks grouped together, gives us more diversification, allows us more protection against market downturns if done correctly. And that's where, understanding these differences between, say, stocks and bonds. So stocks, where I'm buying ownership in a company, bond in my investment, bonds where I am loaning money to that corporation or that government entity for that matter. Now sometimes people think bonds are really safe, and it's promoted that way many times. However, understanding bonds also have risk. Both interest rate risk, credit risk, inflation risk, and we're talking about bonds. So when interest rates are going up, for instance, bond prices typically go down, meaning you could potentially lose money. You may have bought, paid $50,000 for a particular bunch of bonds, and interest rates go up, and those bonds, you want to sell them, and maybe you could only get $45,000 or $40,000. You take a loss. So understanding the effect of interest rates. Now, one thing that goes with that, and I've talked about it many times on the show, long-term bonds, especially mortgage-backed securities is an example. When you're getting into, anything over 10 years, but with mortgage-backed, you're talking, of course, even 15, 20, 25, 30-year bonds, all right? These are even more interest rate sensitive. So as interest rates go up, and we saw that last year, right? Interest rates went up quite a bit, and that had a negative effect on bonds. And you could have, if you're needing to sell those bonds at that time, right, then that could cause you loss. Now here's the other part. If you're in a bond mutual fund, you may not even be the one making the decision, right? That money manager is making it. They may be selling, and you may see your investment portfolio go down as a result of that. So one of the things is just understanding these principles. So if I'm going to invest, and I do want to invest in bonds, but I want to stay with short to intermediate term, investment grade bonds. So investment grade means these are the highest credit quality. These are the ones with the least risk of default, okay, as opposed to high yield bond funds, which have a lot of junk bonds in them. Low credit quality, higher risk of default. Yes, they're paying a little more interest, but at the risk that you may get with default, you'll take losses, which reduces greatly your net return, potentially even creating a negative rate of return. So understanding how bonds work in a portfolio to minimize volatility is when you stick with is the different the different terms, if you will, duration of those bonds and the type of bonds they are. So we're concerned about duration, how long-term are the bonds, and we're concerned about credit quality. We want investment grade. So again, short to intermediate term, which means 1 to 9 years, let's say, under 10 years in length, and investment grade quality. Those are the kind of bonds we want in our portfolio. That will reduce volatility. They tend to have what's called a negative correlation to the stock market, simply meaning when stocks are down, those bonds should hold up and reduce those losses, that volatility for you. And then staying disciplined is a big part. Now, also some cash equivalents like CDs, treasury bills, money market funds, fixed annuities can fit into this category. Now, fixed annuities, and I'm going to be very, this is also important to understand this asset class. We're talking about fixed indexed annuities, uncapped fixed index annuities. And that's real important to understand the credit quality of the company, that they're uncapped, meaning that there's no limit to how much they can make. And they're tied to different indices, and there's different ones here that we want to look at the quality of the indice as well. And the participation rate, there's a number of different factors that go into them. But utilizing, research is showing us, and there's a number of white papers I'm happy to share with you anytime if you want to contact my office for that. And these white papers show basically that these uncapped fixed index annuities can help you even, when blended in your portfolio, can outperform bonds with lower risk and give you even more diversification in your overall investment plan. And it has some other advantages as well. All right, but you also notice, by the way, to the left, when the stocks, higher potential returns, higher level of risk. To the left, lower potential returns, lower level of risk. It's how to blend these together to both reduce risk and still get the market return we're seeking. And we're going to talk about that more, but first we're going to take a break. Join me here. We'll be right back on the Retirement Report.